When companies are staring down those really big investment decisions, the ones that could make or break them, how do they actually decide? How do they figure out if, say, pouring millions into a new factory is the smart move long term?
Right. That's where capital budgeting comes in.
Exactly. So today, we're diving into that. Think of it as the essential playbook companies use for evaluating those major projects.
hmm
We've looked at a bunch of material on these financial models, and the aim here is really just to give you the core ideas, the framework they use.
And it really all starts with cash, doesn't it?
Yeah,
Understanding the flow of cash.
absolutely. Where do we begin with that?
Well, you've got direct effects. That's the obvious stuff. Money immediately coming in or going out, like paying cash for a new piece of equipment.
Okay, straightforward.
But then there are the indirect effects. These are things that aren't cash transactions themselves, but still impact your cash position. Depreciation is the classic example.
Ah, right. Not cash out, but it affects taxes.
Exactly. It's a tax deduction. So you pay less tax, which means ultimately more cash stays in the business. It's a tax shield effect.
So the net effect is what matters, adding up the direct cash and these indirect tax savings, things like that.
Precisely. You need the full picture.
And this picture unfolds over time, right? It's not just a snapshot.
Definitely not. We usually break it down into stages. First up is inception, the beginning.
The initial cost.
Yes, the big cash outlay to buy the asset. But it's oft more than just the sticker price. You might need more working capital, inventory, receivables, just to get the project running. That's an outflow initially.
Okay, so more cash tied up at the start.
Right. But you usually get that back at the end. Also, if you're replacing an old asset, what you do with it matters.
Like selling it.
Selling it brings in cash, which reduces your initial investment cost. But watch out for taxes on any gain. Or if you scrap it at a loss, that loss might save you some tax. It all tweaks that initial number.
Got it. So inception is the setup cost, considering all these bits. Then comes operations.
Yep, the middle phase. This is where, hopefully, the project starts making money, direct cash inflows from sales or savings. And you keep getting those indirect benefits too, like the depreciation tax shield year after year.
Makes sense. And the final stage, disposal.
Right, the end of the line for the asset. You might sell it direct cash inflow. Maybe some costs to get rid of it direct outflow.
And taxes again, I assume.
Oh, absolutely. Tax on the gain if you sell it for more than its book value, or a tax saving if you sell it at a loss. Plus, remember that working capital from the start?
It gets released.
Exactly, it's freed up. So that's an indirect cash inflow right at the end.
Okay, a whole life cycle of cash movements. Now, critically, when we analyze these flows, do we look at the raw numbers, or is it all about the after-tax amount?
Always after tax. Always. For making smart decisions, you have to consider taxes. The government gets its share or sometimes gives you a break, and ignoring that gives you a distorted picture.
Right. So, like, if a project brings in, say, $40,000 before tax.
Well, let's say you also have $10,000 in depreciation related to it, and your tax rate is 40%. The tax calculation isn't just on the 40K, it's on the profit after depreciation. So 40K inflow minus 10K depreciation is 30K taxable income. 40% tax on that is 12K.
So the after-tax cash flow isn't 40K minus 12K?
No, be careful. The cash inflow is 40K. The cashed outflow for tax is 12K. So the net after-tax cash flow is 40K minus 12K, which is $28,000. The depreciation itself wasn't cash, but it saved you tax on 10K.
Okay. After-tax is key. So we have these after-tax flows projected out. How do we actually decide yes or no? I hear net present value, NPV, mentioned a lot.
NPV is really the gold standard for many. The core idea is, does this project generate returns greater than our required rate of return, our hurdle rate?
And how do we figure that out?
You estimate all those future after-tax cash flows, then you discount them back to what they're worth today, using your hurdle rate as the discount rate. Then you compare the present value of all those future inflows to the initial investment.
And if the present value of the inflows is bigger...
If the total PV of inflows minus the initial cost, the NPV, is positive, the project is expected to create value. So, accept it. If it's negative, reject it. Zero means, well, theoretically indifference.
Why is it considered superior sometimes?
A big advantage is flexibility. You can use different discount rates for different periods if you expect risk to change, and it measures value creation in absolute dollar terms.
Makes sense. What about IRR, the internal rate of return?
IRR is another popular one. It calculates the discount rate at which the project's NPV would be exactly zero. So it's essentially the project's expected percentage rate of return.
And the rule?
Simple. If the IRR is higher than your hurdle rate, accept. If it's lower, reject.
But there's a catch, right?
Yeah, the main criticism is the reinvestment assumption. IRR implicitly assumes that all the cash flows generated by the project can be reinvested back into the company and earn that same IRR. That can be unrealistic sometimes, especially for very high IRRs.
Okay, so NPV gives dollars, IRR gives a rate. What about something simpler, like the payback period?
Payback is definitely simpler. It just asks, how long does it take to get my initial investment back?
Purely about speed and maybe risk.
Exactly. If you have steady cash flows each year, you just divide the initial cost by the annual cash flow. If they vary, you just add them up year by year until you cover the initial outlay.
But the big drawback.
It totally ignores the time value of money. A dollar today is worth more than a dollar next year, but payback doesn't care. And it ignores all cash flows after the payback point. So you might pick a project with quick payback, but lower overall profitability.
Right, a quick look, but not the whole story. Okay, one more I've seen is EVA, economic value added. How's that different?
EVA tries to measure the true economic profit, it asks. Is the project generating returns above the cost of the capital used to fund it?
How is it calculated?
You take the net operating profit after taxes, or NOPAT, and subtract the required return. That required return is your total investment amount multiplied by your weighted average cost of capital, the WACC.
WACC being the average cost of debt and equity.
Basically, yes. The blended rate the company has to pay for its funding. If your NOPAT is higher than that capital charge, you have positive EVA. You're creating real wealth. Negative EVA means you're destroying value.
So it links profit directly to the cost of funding it. Interesting. And finally, just briefly, where does probability fit in?
Well, the future's uncertain, right? All these cash flows are just estimates. Probability helps us think about different possible outcomes. Maybe a best case, worst case, most likely case, and expected value lets us calculate a weighted average outcome based on how likely each scenario is. It adds a layer of realism to the estimates.
Okay, wow, so quite a toolkit there.
Yeah.
We've got NTV looking at value in today's dollars, IRR giving us that percentage return, payback focusing on speed, and EVA measuring true economic profit.
Exactly. Each one gives you a different angle, a different piece of information, all centered around those crucial after-tax cash flows and whether the returns justify the investment. Understanding them helps you make much more informed decisions.
Definitely. So thinking about all these different ways to slice at future value with NTV, the rate focus of IRR, payback simplicity, EVA's economic profit view, what factors do you, our listeners, think are ultimately the most critical when you're evaluating a really significant financial commitment? Something to ponder, for sure.